It's for an investor who's thinking ahead, it's wise to be a little conservative. Never, never, never get out of the market.
If you're an investor, what can happen to your portfolio in an overvalued market? This is a critical question as we are in 2024, a year where market valuations are significantly high. In this video, we look into Jack Bogle's insights on market valuation, historical performance, and asset allocation. Stay tuned as we break down how to navigate these turbulent times using Bogle's timeless advice. By the end of this video, you'll have a clear strategy to protect and grow your investments in an overvalued market.
Tons to talk about. Let's just start maybe with a kind of a synopsis of the last 10 years. What are the lessons we've learned and where are we right now in the post-financial crisis world?
Well, this is a great time to ask that question because it seems pretty clear to those of us who are expert, who may know nothing, never forget that, that we're going into an era of much lower returns than we've been accustomed to in the past. And how that will play out, nobody knows. I would be in the camp of saying the market is significantly, not grossly, but significantly overvalued. And assuming that's correct, there are only two things that can happen. You can have a long period of very low returns or a great big drop in the market, 30%, 40%, even 50%, and then get back to the good returns of the good old days. That's a hard way to do it. But it seems almost inevitable that returns will be lower somewhat than this 35 years or so that we've had the greatest bull market in recorded history, with the S&P 500 growing at 12% a year, which means, mathematically speaking, simply enough, that if you started with the S&P 500 35, 40 years ago, you now have $60 for every dollar you started with. And so it's not genius.
Jack Bogle emphasizes that we're entering an era of lower returns due to high market valuations. When markets are significantly overvalued, the likelihood of substantial returns diminishes. Take the late 1990s dot-com bubble as an example. Investors poured money into tech stocks, driving prices to unsustainable levels. When the bubble burst, many saw their investments plummet. To illustrate this with some numbers, during the height of the dot-com bubble in March 2000, the NASDAQ Composite Index reached a peak of $5,048.62. By October 2002, it had fallen to $1,114.11, a staggering drop of over 75%. Investors who were caught up in the speculative frenzy saw their portfolios wiped out. Those who had held diversified portfolios fared better but still faced significant losses. Today, we might face a similar scenario. High valuations mean that future returns could be modest. For example, the current Shiller PE ratio, which adjusts for inflation and cyclical earnings, is hovering around 38, significantly higher than the historical average of around 17. This suggests that the market is overvalued compared to historical norms. Bogle suggests that either we experience a long period of low returns or face a significant market correction, potentially seeing drops of 30 to 50%. This situation can be likened to buying a house in a booming real estate market. If you purchase when prices are at their peak, your future returns are likely limited. You might have to wait many years for the value to appreciate significantly, or worse, face a decline in value if the market corrects. Understanding this can help investors set realistic expectations and prepare for various outcomes. Reflecting on historical performance, Bogle notes that the S&P 500 has enjoyed extraordinary growth, with an average annual return of 12% over the past few decades. Take a $1,000 starting point in the early 1980s to demonstrate this point. With compound growth, that investment would be worth approximately $60,000 today. However, past performance is not always indicative of future results. The exceptional returns of the past were partly driven by favorable economic conditions and lower starting valuations. For example, in 1980, the S&P 500's PE ratio was around 7.4, making stocks relatively cheap. This provided a strong foundation for growth as the economy expanded and corporate earnings increased. Today's high valuations suggest that replicating such returns will be challenging.
It's the market. And you kind of wonder how the mutual fund industry has held itself together against the onslaught of indexing. And I think the answer to that is in this great bull market, if you had a 10% return, which is roughly what the average fund has given you, you got 40 times your money instead of 60. Well, nobody's looking at the 60, and they're saying any manager that can take my dollar or take my $10,000 and turn it into $40,000 is my friend forever. And he's a genius, and he's actually fallen way short of the market. So one of the lessons is, I think, or one of the messages, perhaps more importantly, is the trees don't grow to the sky. And I'm really quite confident about that. But confidence in this business is a dime a dozen.
Jack Bogle pioneered the index fund, which has outperformed many actively managed mutual funds over the long term. In an overvalued market, index funds continue to offer a cost-effective and diversified investment strategy. Bogle's vision was to simplify investing, reducing costs, and improving investor returns through broad market exposure. Consider the numbers. If you had invested $10,000 in an average actively managed mutual fund 40 years ago, you might have seen it grown to about $400,000. However, if you had invested the same amount in an index fund mirroring the S&P 500, you could have seen it grown to $600,000. This difference is due to the lower costs and broader diversification offered by index funds. In 2024, the average expense ratio for actively managed mutual funds is around 0.74%, while index funds average just 0.09%. Over time, these cost savings compound, significantly boosting returns. For example, over 30 years, a $10,000 investment with a 0.09 expense ratio could grow to $76,000, compared to $68,000 with a 0.74% expense ratio, assuming a 7% annual return. Bogle's creation of the index fund democratized investing, making it accessible and affordable for everyone. This approach is particularly valuable in an overvalued market, where minimizing costs and maximizing diversification can help you protect and grow your investments. By sticking to a low-cost, broad market strategy, investors can avoid the pitfalls of high fees and underperformance associated with many actively managed funds.
So I'll just take a moment maybe to talk about my methodology. And this methodology is so good and so popular that it has never been used by anybody but me. But for 25 years, I've been using the same methodology, so it's all what actually happened after prediction. And I divide the market, the market return, into its two sources. One is investment return, one is speculative return. What is investment return? Today's dividend yield plus whatever earnings growth we get in the future. It's averaged about 5%. Could get to 6%, 6 or 7%. It can't really be much higher than that. And unless you get a depression, it's not going to be much lower than 2. So there's not a lot of room to differ there. But I'm using right now for the next, the long-term average is about 5% earnings growth. So we take today's 2% dividend yield, and my guesstimate, gives us 6% investment return. The other part of it, which is the more troublesome part, is speculative return. And speculative return relates to valuations, which we can easily measure by changes in the price-earning multiple. And if PE goes from 10 to 20, that's 7% in a decade. I don't do anything short of a decade. If it goes from 10 to 20, that's 7% of extra return. And we got that in the 80s, and we got it again in the 90s. And we're not going to get it again, because PEs can go from 10 to 20 to 40, but I don't think they can go to 80, which would be required if you follow the math. Sorry to bother you with those numbers. So I think any responsible market predictor should look at these three elements of return, two elements of return, investment and speculation. And so I expect the market return to be 12% or X. I accept, here's what the dividend yield is, we all know that. Here's my estimate for earnings growth. We can't be too far different on that. 3 or 4 percentage points would be a lot. And then here's my belief on the valuation of the market. And So I believe that we will probably go, the PE in the market is about 25 times today. That PE is based on GAAP earnings, accounting earnings, and not operating earnings. Operating earnings are much higher, leaves out all the bad stuff. Always a good idea if you're promoting something. And if it goes to 18 times, say, that 6% that I gave you from investment return, take off 2 percentage points for the drop in the valuation, would give you about a 4% return in the stock market over the next decade. Now, we've been doing this in 10-year periods for 25 years. That means we have 15 actual predictions, and they have a correlation of about 0.81 with the actual returns. Some of the errors were fantastic. You couldn't imagine you could be so far off. And actually, my very first estimate was the worst one. And that, as I said, the market return would be about 11% in the decade of the 1990s, beginning 1990, and it turned out to be 18%. But by 2003, the 13-year return was 11% because the market went up, stopped at the high, and went down. So timing is a funny part of it. But I still go with that because it's the reality of life.
The way Jack Bogle predicts how the market will do is based on keeping things simple and consistent. As he mentioned in the clip, he focuses on two elements: investment return, which is dividends and earnings growth, and speculative return, which is changes in price-earnings ratios. Over the past 25 years, this approach has provided a clear framework for understanding market movements. For example, let's talk about the 1970s, a decade marked by high inflation and economic uncertainty. Despite these challenges, investors who focused on dividends and earnings growth could still achieve solid returns. For example, during the 1970s, the average annual return for the S&P 500 was about 5.8%, with dividends contributing significantly to this return. The S&P 500's average dividend yield over the past 50 years has been around 2 to 3%. Coupled with historical earnings growth of about 5 to 6% annually, this forms the investment return. In contrast, speculative returns widely vary based on market sentiment. During the dot-com bubble, the speculative return was significantly high as investors drove up stock prices without corresponding earnings growth. To illustrate this, in 2000, the S&P 500's PE ratio peaked at 44.2 due to speculative enthusiasm. However, earnings growth did not match this excitement, leading to a market correction. Because of the volatility of speculative returns, the S&P 500 experienced a drop of approximately 45% between the years 2000 and 2002. Bogle's predictive accuracy over the past 25 years demonstrates the reliability of his methodology. Despite occasional errors, the correlation between his predictions and the actual returns has been remarkably high. This history shows how important it is to focus on real investment returns instead of speculative gains. Bogle's method gives investors confidence because it is based on decades of consistent and successful market analysis. For instance, Bogle's predictions in the early 2000s accurately foresaw the lower returns following the dot-com crash. His focus on dividends and earnings growth provided a stable framework, contrasting with speculative frenzy that preceded the crash. Similarly, his conservative estimates during the housing bubble of the mid-2000s warned of potential overvaluation, which eventually led to the 2008 financial crisis. Just as accurate weather forecasts help us prepare for storms, Bogle's market predictions help investors navigate financial turbulence. Bogle explains that speculative returns are closely tied to market valuations, specifically the price-earnings ratio. When PE ratios rise dramatically, as they did in the 1980s and the 1990s, it indicates increased speculation. However, these ratios cannot rise indefinitely. To highlight this, consider the Japanese asset price bubble of the late 1980s. PE ratios for Japanese stocks skyrocketed, driven by speculative mania. At its peak in 1989, the Nikkei 225's PE ratio reached nearly 60. When the bubble burst, Nikkei index fell by over 60% in just 3 years. and Japan entered a prolonged period of economic stagnation, known as the Lost Decade. Today, the US stock market shows similar signs of elevated valuations. The current Shiller PE ratio is around 35, compared to the historical average of 16 to 17. This suggests that much of the recent market growth has been driven by speculative returns rather than fundamental earnings growth. By understanding the relationship between speculative return and market valuations, investors can better navigate market highs and lows.
And the question really today, the big question I think for the marketers, the market itself, or market experts, or investors for that matter, is will there be a reversion to the mean of the price earnings multiple, or are we in some new lofty territory, a permanently high plateau? Quoting from somebody who said that right before 1929, I think it was Roger
I was
Babson.
going to say.
I don't believe in permanently high plateaus.
Yeah, well, so when do we jump off this plateau, and what triggers it?
Well, I would have no idea about when. I just don't know, so it's not really much point in guessing. I mean, it could be today, and it could be not a big fall at all, but just low returns. But I think the combination is pretty much set up to have returns in the range of 4% for stocks in the next decade. Now I'm a little embarrassed because that's what most people are saying. That's essentially what BlackRock is saying, Larry Fink. It's essentially what Vanguard is saying. And I usually, in my predictions, I don't like company. The crowd, I was always taught the crowd is always wrong. So we will see, but I think it's, for an investor who's thinking ahead, it's wise to be a little conservative. Never, never, never.
Historically, periods of high valuations are often followed by corrections. This skepticism is rooted in the belief that markets eventually revert to the mean. Investors should remain cautious and avoid the temptation of chasing high-flying stocks based on speculative hype. With current market valuations high, driven by speculative enthusiasm, the risk of a correction looms large. It's important for investors to maintain a disciplined approach, focusing on long-term value rather than getting swept up in the market euphoria.
Asset allocation. That if you go back to 1949 and read Benjamin Graham's The Intelligent Investor, he said never less than 25% or more than 75% in either of the two asset classes, bonds and stock. So you can be 25 stocks and 75 bonds, or 75 stocks and 25 bonds, and stay in that range. And you want to make a few little adjustments, do that, but don't think there's a scientific way to do it.
Bogle's advice on asset allocation emphasizes balance. For example, during the 2008 financial crisis, investors heavily weighted in stocks saw severe losses. Those with balanced portfolios, however, were better positioned to weather that storm. For example, a portfolio with 60% stocks and 40% bonds would have been less volatile, protecting investors from market drops. In numbers, if an all-stock portfolio dropped 40%, a balanced 60-40 portfolio might have only dropped around 25%. This difference highlights the protective power of diversification and balanced asset allocation. Bonds offer stability and income, which balances out the risk of stocks. If this video helped you understand how to navigate an overvalued market using Jack Bogle's principles, check out our next video to learn Warren Buffett's strategies for making money during the challenges of 2024's inflation.